When you talk about the speed and scope of this de-dollarization, the arbitraging of gold in the commodity markets, the settling outside of the US dollar and physical precious metals, it's undeniable. It's not a gold bug or gold bull sensational headline. It's simply empirical, objective reality.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 15th through January 22nd, 2024, while supplies last. This week, all our specials come from the Royal Canadian Mint, one of the most respected mints in the world. First, we feature backdated 1-ounce silver maples at $3.75 over spot with a minimum order of 50. Next, RCM new style 10-ounce silver bars at just $2.75 over spot with a minimum order of 4 bars. We also have backdated quarter-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Matthew Piepenburg, partner at Greyerz AG. Matthew, thank you so much for joining us today.
Good to be back, Elijah, as always. I enjoy the conversations.
Well, it's great to have you today. And as we kick off the new year, I thought we could discuss de-dollarization, this trend that has been happening for quite a while. And you've been talking about it ever since Russia. We had the dollar weaponized against Russia, right, with the Russia-Ukraine war. Now, you've been saying that de-dollarization will accelerate, but it's still going to be a slow process. Now, in your recent article, you said that it's accelerating a lot faster than even you anticipated. So can you expand on this?
Yeah, it's fascinating. I mean, all these themes, the dollar, debt, currencies, weaponized dollar, the BRICS, they're all interrelated. And obviously, when the sanctions came out against Putin in 2022, I and many others were saying this was a game changer. This was a watershed moment. Grant Williams, Jim Rickards, many others. It was incredibly myopic policy on the West. This argument that Russia would run out of money before the West ran out of energy just proved to be untrue then and now confirmed to be untrue today as Poland goes nuclear and Germany's burning coal in the winters. So this idea that you could weaponize a world reserve currency was a disaster from the beginning. I said, like the de-dollarization or the decoupling of gold in 71, that the process would be slow. Just as Nixon welched on the gold standard in 71, the inherent purchasing power of the dollar got weaker and weaker in death by 1,000 cuts when measured against gold. And I said in a similar way, this weaponization of the world reserve currency, which again, Robert Triffin, Keynes warned against, even Barack Obama in 2015 said that would be a mistake. I said that would be a slow process, death by maybe 100 cuts in terms of the dollar's supremacy and hegemony. Its supremacy is still very much there. Its hegemony is irrevocably lost. And in 2022, from day one of the sanctions, we said that just pushes Russia and China closer together. It also incentivizes the BRICS to expand. And in just the brief period since 2022, the speed and scope of that expansion is happening faster than I thought. In the context of the most recent article, that was just in an allusion to 2023 oil sales. For the year of 2023, 20% of the oil sales were outside of the US dollar. You can't overestimate or underestimate or overstate the importance of that simple change. That's one example. When you have Russia selling oil now to China and China paying for that oil in yuan, which the Russians can then convert to gold on the Shanghai Gold Exchange, or when you see the 200-day moving average in the Shanghai Gold Exchange repricing gold differently than in London and New York, this de-dollarization process, not just between China and Russia, but among all the BRICS nations, which are de-dollarizing in the commodities market, you can't ignore the significance of that. You simply can't. And the speed in which it's happening is extraordinary. And it's also even Saudi Arabia in the oil trade. It's very important. Saudi Arabia now does more trade with China than it does with the US and Europe combined. So these are important changes that are happening because no one trusts the US dollar as a neutral reserve asset anymore. Central banks are making record-breaking purchases of physical gold and not US treasuries. Since 2014, there's been over 100 billion negative in US treasuries and 500 billion up in physical gold among the central banks. These oil changes, this de-dollarization in the BRICS market, the size of the trades happening among the BRICS, the bilateral agreements outside of the US dollar, now well over 45 countries doing that. You can't ignore that. And the speed and scope of that, again, since 2022, since the West in general, and the US in particular, spearheaded this weaponized dollar against Putin, it has completely backfired. It was a headline-making attempt to destabilize the ruble and flex Western muscle, but the Western financial and military muscle just isn't what it was promised to be, not only on the battlefields of Ukraine, but in the US Treasury markets, in the central banks. We're seeing evidence of that objectively as a failed policy. And again, it's not trying to be anti-American or non-patriotic. I think you have to be very patriotic and say we have to have better statesmen, better financial savvy when we're making political or international decisions like this. I think it was a fiasco, straight and simple. And it does, obviously, when you talk about the speed and scope of this de-dollarization, the arbitraging of gold in the commodity markets, the settling outside of the US dollar and physical precious metals, it's undeniable. It's not a gold bug or gold bull sensational headline. It's simply empirical, objective reality. And it has a massive impact, as we can discuss, on the US dollar and in the very important milkshake theory, for which I have a great deal of respect.
Now, speaking of the petrodollar and the milkshake theory, a lot of people out there are skeptical that the petrodollar will ever really end, right? That the dollar's link to oil will be there indefinitely in the future, and that the connection is just too great. And back in 1975, as you mentioned in your recent article, there was talk about breaking that link between the dollar and oil, but it never happened. So what gives you confidence today that that link will eventually be broken?
Again, and I want to be very thoughtful on this because I don't want to be sensational. And again, this goes to a number of themes. Oil in particular, de-dollarization, or the dollar in general, they're all tied together. You start with respecting these skepticisms. You have to respect the skepticism on oil or de-dollarization. And again, this is why I have so much respect for Brent Johnson, who I think has a great diagnosis of where we've been for many years with the dollar being undeniably strong. Because, as he said, there's this great big straw throughout the world, in the Eurodollar markets, in the derivative markets, in the oil markets, the petrodollar. This great big sucking sound on this straw for US dollars. That is the world reserve currency. It's not going to be replaced by the ruble or the yuan or the peso anytime soon. And so you have this tremendous natural demand for the dollar. And I think it's a great diagnosis. Where I think it's not as a good prognosis. I'm not saying next week, next month, over the next 5 to 10 years, I think there's strong evidence that that straw has some massive cracks in it. The first and most important crack in the milkshake theory straw, I think, is it underestimates the US Treasury market by focusing too much on the US dollar or the DXY. The demand for the US dollar, look, it's 80% of world trade is settled in dollars, 70% of GDP is in dollars. So the demand for the US dollar is strong. But the demand for the US Treasury is tanking. That's objective. That's empirical. Again, central banks, investors it's clear that there's a distrust of that US Treasury, that US IOU, because there's so much issuance, fiscal and monetary stimulus in combined, that's debased the faith in the U.S. Treasury. It's a declining asset when Powell was raising rates from a debtor, that's massively in debt, 34 trillion in public debt and climbing. So it's a declining asset from a bad credit. That's just the U.S. Treasury market. So when the U.S. Treasury market has less demand, the Fed will have to monetize that demand unnaturally and print money. So that actually affects the dollar negatively. Oversupply of dollar, less demand, massive crack in the milkshake theory straw, in my opinion, over time. But that's happening in real time. We can talk about Powell's pivot in a minute, but you can't deny that that's an objective reality. As to the oil market, the petrodollar since the 70s, since 73, absolutely no coincidence that when Nixon welched on the gold standard, in other words, decoupled the dollar from its chaperone of gold, that they were looking for some serious demand for that dollar when it no longer had a gold chaperone. So Nixon and every other president since could print at will to support policies, to stay elected, to export inflation throughout the world, to be the bully currency of the world, the exorbitant privilege of that. But it wasn't long after we decoupled from the dollar in 71 that Kissinger and Volcker and Nixon were standing around, and anyone else was, how do we get demand for this dollar? Let's run off to the OPEC countries. Let's convince them that our dollar should be the purchase mechanism for oil internationally. That was an amazingly important coup to pull off for the US dollar as a world reserve currency. People forget that at that time, it wasn't a foregone conclusion that Saudi Arabia or OPEC would just adopt the US dollar. Because for many years, when the dollar was backed by gold, oil prices were very stable. Once the dollar decoupled from gold, the volatility, I can send a chart on this, the volatility of the oil price was all over the map because it no longer had that golden chaperone. So OPEC nations were legitimately saying, why should we trust your dollar? At the same time that they were questioning that, and Kissinger was trying to strike deals to save the dollar's demand, Volcker was raising rates by 18%. We had positive real rates of 5 to 8% at that time in the early 70s. Because Volcker could raise rates to make the US dollar and the US Treasury look more attractive to OPEC. Fast forward some 50 years later, that dollar, that Treasury, and that US Fed is not the same as it was in the Volcker era. Powell cannot raise rates by 18% to strengthen the dollar, to keep it sexy, so to speak, for OPEC. And the US Treasury isn't what it used to be. Our debt levels aren't what they used to be when Volcker was in office. And so we have a very different US dollar, a very different US Treasury. So that's math. OPEC is many things and Saudi Arabia is many things, but they're not stupid. This dollar isn't what it used to be. This IOU isn't what it used to be. Frankly, this White House isn't what it used to be. Whatever your stance on that, you can be a lifelong Democrat. There's clearly a leadership vacuum right now in the mental state of our president. I think that should be undeniable at this point without being partisan. It's also no coincidence that, again, symbolically, when Trump goes to see the Crown Prince in Australia, he gets, in Saudi Arabia, he gets a fist bump after calling the Crown Prince in Saudi Arabia a pariah state. And then when the Crown Prince meets Xi, it's a handshake. And when you look at Saudi Arabia, now official member of the BRICS, it's a talking partner of the Shanghai Cooperation Organization. It's involved in the new development bank with the BRICS. It's making more trade with China than it is with the U.S. You can't deny these things are happening. And Saudi Arabia, unlike Libya and Iraq, who tried to decouple from the petrodollar with gold or with euros, we know what happened with Gaddafi. We know what happened to Saddam Hussein. I don't think the Saudi Arabian Crown Prince as is worried about being, quote unquote, taken out literally or militarily or geopolitically in the same way, because Saudi Arabia is not Libya. It's not Iraq. It has stronger alliances. So you're seeing movements clearly where Saudi Arabia is turning its back to the West and turning its chin towards the East. I'm not saying tomorrow's the end of the petrodollar, but when you look at the percentages of oil being sold outside the US dollar just this year, when you look at the movement of the BRICS, when you look at the arbitrage for gold for oil, you can no longer ignore that as just not possible. And I think the other argument that you could make in favor of this perpetual petrodollar is, look, the UAE, Saudi Arabia, their currencies are pegged to the dollar. Why would they want to hurt the dollar or get outside of the petrodollar? But the simple fact is, well, not fact, but my strong opinion is that just because the dollar was once powerful, it's not immortal. And I think it's not impossible at one point for Saudi Arabia, the UAE, or other OPEC nations to simply depeg from the dollar and repeg to gold in some direct or indirect way. And that's not a gold bug argument saying it's going to happen tomorrow. But all the indicators are there that there's a clear reshifting, repricing, reexamination of the US IOU and the US dollar. And no one, including myself, can time that. But there's absolutely no doubt that the evidence is quite overwhelmingly in that direction. And again, when you look at the global supply of oil and you look at the global supply of gold, even a small repricing or small repegging to gold would have a dramatic impact on the gold price. Because as a neutral asset, neutral reserve asset, whether you're a central banker or an OPEC nation, trust in that US dollar since the Putin sanctions has completely changed. I said many years ago when that happened, or a couple of years ago when that happened, said that's an irrevocable change. The genie doesn't go back in the bottle. Once you've, quote unquote, deceived your spouse that openly, the trust is very hard to regain. Whether you're friendly or not so friendly with the US, that world reserve currency will never have the same trust. And that's critical.
And looking at its impact on the gold price, if we go back to 1975, we saw a huge run up, as you mentioned in the article. Gold, went it went multiples higher from where it was, even just on the suggestion that the dollar could be separated from oil. So in this case, if we start having the suggestion, but it seems like we are, and we actually do have that break, what will it do to the gold price in your view?
Well, absolutely. It's obvious there'll be astronomical change in the gold price. It's no longer the suggestion of 1975. We're seeing momentum in that direction. And again, I'm not saying it's an absolute depegging tomorrow or next year. It's already happening indirectly among the BRICS nations. They're finding ways to trade around the US dollar. And I said, even before the announcement when Saudi Arabia with the BRICS, and even during the summer of last year, everyone thought there was going to be a gold-backed BRICS currency. I never thought that was necessary or was going to happen. It wasn't because I'm particularly genius. It just wasn't necessary. You don't have to have a gold-backed BRICS currency to make gold an extremely important part in arbitraging trade among the BRICS. It's like a glorified barter. As I've said before this announcement, or even before the data came out on oil, you can sell oil in London. You can play an arbitrage. You can sell oil in London. You can buy gold, ship that gold to a yuan-based trade hub, and you can convert that gold to yuan and then buy oil outside of the US dollar. And that was already happening among BRICS, certainly was happening between Russia and China, but other nations can do that as well. And you've got Saudi Arabia making deals behind the scenes or preparing to make deals where they can sell oil outside the dollar. Again, this isn't sensational, this is reality. And so even if you have, again, when you look at the global oil production, you look at global gold production, even if you have a small shift in demand for oil outside of the dollar and in some type of arbitrage gold play, the gold price will go up significantly. We're talking this year, we're thinking for a number of reasons, many in our industry are targeting at least 2,500, but that to me is conservative. Again, don't ask me to time it. Gold never moves in a straight line. The direction though, between the BRICS, between the central banks, between the petrodollar, not to mention just the US's massive debt spending. It's an election year. They're going to deficit spend. We went from 33 to 34 trillion quickly. We'll go to 35 and 36 trillion just as quickly. So we're spending more than we earn. The combination of our monetary balance sheet, which is a banana republic, but for the fact the world reserve currency, the combination of that debt reality in the US, the election year spending that's coming, the central bank purchasing of gold over U.S. treasuries, the weaknesses I see in the petrodollar, the momentum I see there, the weaponized U.S. dollar, all of these things point inevitably towards higher gold prices. And again, it's not because gold somehow got shinier or stronger or more immortal. It's just that currencies, including the U.S. dollar, are getting weaker. And this is confirmed by the current events that we're seeing on the headlines and the current movements in the yield curve and the current movements of the Fed and the current movements of geopolitics. But it's also just the fingerprint of history. Throughout history, as I've said so many times, whether you're going to ancient Rome, whether you're going to Yugoslavia in the 90s, whether you're going to the Weimar Republic, which is an exaggeration like Zimbabwe, or whether you're going to 18th century France or the Ming Dynasty, whenever an empire finds itself over its saddle, over its skis in debt, it debases its currency to quote unquote save the system. I see that no different in the US. We are a classic example of a regime or an empire or democracy or a monarchy, whatever example you want to give throughout history, that has way too much debt. 120% debt to GDP, 8% deficit to GDP, negative 65% net international investment. These are just empirical facts. We were broke. We may be the world reserve currency. We may be the strongest economy. We haven't reshored all our manufacturing, but we are broke. And whether Santa Claus, Biden, Trump, or somebody else is the president, or there's a whole new shift, you can't fix that overnight. There is going to have to be some constructive destruction. And the main way they're going to fix it throughout history, it's always the same, I see no exception, is to sacrifice the currency to save the system, to save the US Treasury market in particular. That is essential. The bond market is the thing. We've tried to save it, backdoor QE through the TGA program, through different issuance on the short end and the long end, the TBFT program to save the banks. We've been doing backdoor QE. Now Powell's announcing a pause, then a pivot towards lower rates projected in 2024, which I think he'll do. And then eventually we'll see mega QE to support the US Treasury market, which is an unloved asset globally. So they will have to support the Treasury market. To do that, by simple math, They're going to have to resort to synthetic liquidity, i.e. QE direct, to support the yields and to support the bond market at the expense of the currency. That is not gold bug grandstanding. That is history 101. And so that just means more QE, more liquidity, greater debasement of the dollar, higher inflation down the road, inevitable. We haven't beaten inflation. That's another conversation piece, but it's the debasement of the dollar. And so gold's only direction is up and to the right. And again, when you're talking $5,000, $6,000 gold, it's not to be cocky. That just means the cost of bread, the cost of a car, the cost of everything else is going to go up too, including the cost of stocks. It's going to be very bullish for the stock market too, when Powell officially goes from a promised projection of rate cuts to an actual rate cut and then goes to super QE, which I think he'll do. And like Luke Gromen, I think it's inevitable. If they don't, if the Fed continues to raise rates and just is bluffing, gold wins either way, because if the Fed doesn't support the U.S. Treasury market, everything breaks. Everything breaks but the dollar. The market breaks, it'll be a disaster. That will be depression. That will be a recession. But gold will still rise then. If the Fed pivots to super mega QE, which I do think they will, don't ask me what day, month, or quarter, but they will. They already have indirectly. That's good for gold too. Gold wins either way because the Fed is cornered. They can't win. They're going to sacrifice their currency to save the system, especially in an election year, but especially when you're looking down the barrel of 34 trillion, 35 trillion in public debt. Then you throw in unfunded liabilities, military budgets, fiscal dominance arguments. Again, it's not trying to be sensational. It's really, sadly, pretty obvious right now. I'm glad I'm in gold, but I saw this coming. We've seen this coming, but it's actually happening now at a faster pace.
No, I would like to touch on inflation if we can have that conversation there, because, a lot of people, if they're looking at the mainstream numbers, right, the official numbers by the BLS, we're seeing inflation down around 3%. So that's pretty close to the Fed's target, a lot better than the 9% we saw, just a year ago or so. It seems like, again, if you're looking at the mainstream numbers, things are pretty good. But I know, there can be waves of inflation. I talked to Tavi Costa of Cresci Capital, and he says that back in the 70s, and he shows that there were multiple waves of inflation that went up and down. So your perspective on that, where are we headed when it comes to inflation?
First of all, there's always the caveat that the official BLS numbers for inflation are simply fictional, but there is absolutely no doubt, no denying that inflation has come way down from its 9% level to its 2.7% level. It kind of vacillates. There's no doubt that when you raise rates and force a recession on the middle class, or a demand pull recession by crippling them with higher interest rates, that you're going to have disinflationary forces. There's also no doubt that this is not the end of the inflation discussion. So between dishonest reporting and cyclical nature of inflation and fiscal dominance, I don't think this inflation era is even close to an end. As I always say, you play where the hockey puck is going, as Wayne Gretzky said, not where it sits, or in my case, the polo ball. There's backswings in polo. The game changes in a tenth of a second. You're going 35 miles an hour down the field, a backswing comes and you're turning your horse. It's the same with inflation. It's going to turn again, not because I'm a gold bug, but because I'm a student of math and history. And where I look at it is, look, we have this argument about, first of all, why is Powell already throwing in the towel, so to speak, by announcing a pivot or a projected rate cut in 2024 when we haven't even hit target 2% inflation? That was his big obsession for the last couple of years. Got to get target 2% inflation. So why are we already announcing a rate cut in 2024? Because what Powell knows and won't say, and this is I think Luke Gromen and others know it very well, you got to start with the premise that, yes, the Fed's mandate is employment and inflation, but its real mandate is Wall Street and the bond market. And the Fed cannot allow the bond market to tank much further. By raising rates to quote unquote fight inflation, there was too much stress on the bond market. We saw that in Q3 and Q4 of 2022. We saw that in Q1 of 2023. We saw it with the gilt crisis. We saw it with the regional banking crisis. We saw it with the bond prices tanking. Those are not banking crises. Those are bond crises. So Powell, with his official story of raising rates to fight inflation, never even got to target 2%. Now he's already announcing a pivot to lower rates. He will eventually announce a pivot towards more QE, in my opinion. But what's really happening is we have seen, and as the St. Louis Fed themselves came out with their fiscal dominance report in June of last year, that when you get positive real rates of at least 2%, our system, our debt broken system, cannot stomach 2% positive rates. We need inflation to be higher than our yields. We need inflation to get ourselves out of debt. Our bond market can't take higher and higher rates. We've seen that over and over. November of last year, supposedly all this demand for bonds. No, it wasn't. It was 150 billion from the TGA account, and it was issuing more out of the short end of the curve. It was backdoor QE. Yellen and Powell have been a yin and a yang. Yellen really creating liquidity while Powell is being austerity with QT. We've been having versions of backdoor QE. Now we're going to have outright rate cuts and eventual QE. Don't ask me what day in 2024, 2025. We'll definitely see rate cuts, in my opinion, in 2022. I don't think Powell's bluffing this time. The Treasury market, the sovereign bond market can't handle higher rates. That's why he had to throw in the towel earlier than target 2% inflation, which isn't even really 2%. It's much higher than that. But still, there's also no doubt that raising rates throughout 2023 did create disinflationary forces. But as we issue more and more IOUs, whether it's in our war or proxy wars in the Ukraine or a hotter war in the Middle East, or whether it's to cover more and more fiscal spending to get us through an election year, we're going to have to issue more IOUs. The rest of the world isn't buying them at the same pace, so we're going to have to create money out of nowhere to pay for them. That will be inflationary. We will save the bond market. We'll probably save the stock market this year with massive doses of liquidity when needed, but we'll always be at the expense of our currency. Again, gold wins because the currency gets debased. They will debase the currency to save the bond market. That will be inflationary. When you get positive 2% real rates, you hit that wall where our tax receipts aren't enough to pay our true interest expense. If we can't pay our true interest expense, and Uncle Sam, as bad as he is, will never default on the IOU. The beautiful thing about Uncle Sam is he has a money printer in his basement where he can click zeros onto his checking account and pay for that with fake money. That is the story of America post-1971. That is the exorbitant privilege of our currency, your problem. Well, now it's our currency, our problem too, because we can't just export to the rest of the world. The rest of the world doesn't want our IOUs in the same way or our dollar in the same way. We're going to have to eat our own sandwich, so to speak, and it's not a good one. And so we will debase our currency to support our bond market and to support our deficit spending. But that will be at the, again, we will save the system at the expense of our currency. So it's a win-lose. It's one step up and two steps back if you follow the inherent purchasing power of your currency, in this case, the world reserve currency. It's just not what my dad and grandfather used to trade in. It just isn't anymore. And, that's why, again, I push gold because I believe in it, not because I work for gold. Any of us could be pushing bonds for a big bank. I could probably make a good deal of money and get a Wall Street bonus, but you can't live with yourself if you have any sense of the conscience or comprehension of history and numbers and math, in my opinion.
No, what is the true rate of inflation then? And I think that's really important for our viewers to understand the distinction between, the official numbers and the actual cost of living, how much it's going up per year. Because as you mentioned, even if the stock market goes up and if we see a devaluing currency, then that doesn't actually mean that you're gaining, even if, the numbers on the screen are increasing.
Right. It's kind of my analogy of running uphill in roller skates or like a cartoon where you're just running over a cliff and you haven't fallen yet. You're just spinning. So you think you're doing okay, but you're actually getting exhausted. Look, I always said if you're going to compare Powell's war on inflation to Volcker's war on inflation, use the same scale that Volcker used to measure inflation in the 80s and the 90s that we used. We've tweaked that scale. And it's eye-popping, boring to get into all the details and stovepipes of how we've manipulated the BLS. I've always joked it's like a fat camp where you're getting fatter every day, but they tell you you're losing weight because they don't measure fat based on chocolate, beer, or pizza. So they just carve those out or they de-weight those. So as you're getting noticeably larger, the scale is getting noticeably lower. The scale that we use in the 80s and 90s would put inflation, if we're saying it's 3%, that means it's 6 to 8%. And if we're saying it's 9%, it's closer to 18%. In other words, is a fantastic effort to tell a good narrative in DC through the Bureau of Labor Statistics to tell us what the official inflation is. But we all know it's higher than reported. There's also no doubt that because of rising rates throughout the last 15 to 16 months, there have been disinflationary forces because the middle class has been crippled by rising rates and higher inflation. Costs were higher, there's an invisible tax, and then rates were went up, so the cost of borrowing was higher. So there was less demand, there was less momentum, so that was disinflationary. Temporarily. Now, we're going to see higher inflation when the Fed has to monetize more debt. higher inflation is okay if you have a mortgage that's fixed or you have a mortgage that's, as long as your wages go up with inflation. And, if the Fed reports misinflation incorrectly, then your employer is going to adjust for inflation incorrectly. So you're still losing. If your stock market portfolio averages Jeremy Siegel's 8% a year or better, but if real inflation is right around there or not higher, you're again running uphill in roller skates. You're feeling better to see a positive return on your S&P, but the inherent purchasing power of the money you measure your wealth with is getting weaker. And that's why if your central bank themselves won't become gold-backed to protect their currency, individuals can become their own central bankers by acquiring physical gold to protect your purchasing power. It's not a get-rich-quick scheme. It's not Bitcoin. It's not a SPAC. It's not a dot-com stock in the 90s. It won't make you uber wealthy. It will prevent you from getting poorer. In some cases, it will also make you wealthy. Again, my colleague Egon von Greyerz, for whom we named Matterhorn now von Greyerz after, was buying gold at $200, $300. He's not stupid. He did get appreciation, but more importantly, he protected his wealth. And all our clients in 90 countries who have a significant high net worth, yes, they want to see gold go up in price. It appreciates like any asset. But most importantly, their purchasing power of whatever currency they came to us in, whether it was a kroner, whether it was a euro, whether it was a peso, whether it was a yuan, whether it's a Swiss franc, has gotten stronger because it's backed by gold. And again, gold isn't as sexy, nor is it as volatile, and in some cases as euphoric as Bitcoin and others. I don't mock them, but it certainly protects your purchasing power better. For people of wealth, they've learned, and I've learned on Wall Street, when I won the lottery ticket on a dot-com stock, it's okay to be wealthy, but the secret to wealth is not losing it. And the secret, I've seen it in family offices, generational wealth. The big joke is the best way to have a small fortune is to inherit a large fortune, because you don't know how to protect the wealth. You don't have to protect it. You're always speculating, which is an important role in our mindset. But you have to preserve. You have to preserve and speculate. Gold is just simply hands down the best preservation asset. Bitcoin has a role too. It can do both. I think it's more of a speculation asset, not here to mock it, but to preserve wealth generationally and to preserve your purchasing power, the case for gold to me is no longer even that debatable. And again, people say it's a bias. Yeah, it's a bias. I've chosen that bias, but it's a bias confirmed by thousands of years of history and cycle after cycle of empires and regimes and monarchies and democracies blowing up because they spend more than they earn. And the U.S. is hitting that inflection point. None of us can time that, but it's already happening in real time right now.
Well, Matthew, we always appreciate having you on here. If our viewers are interested in learning more, where can they find you? Did you have any last thoughts for our viewers?
Well, as always, just always question, always look at different sides, look at history, look at math, look at my arguments, look at the bond market. I'm a huge fan of Brent Johnson. I think he's brilliant, but you can question him. I think Luke Gromen understands the bond market better than anyone. I get most of my insights from guys like Luke Gromen. I think he's brilliant, but I always question everything. But I think the obvious thought I'm having right now is the evidence is overwhelming. In terms of where you can find these arguments, again, Matterhorn Asset Management is now von Greyerz AG. And von Greyerz, you can always find some gold Switzerland, but it's also at vongreyers.gold or vg.gold. But our old website domain is still Gold Switzerland. You can find us there, goldswitzerland.com. Our website's just been very, very retooled after a year of work. We've got a completely, I think, enhanced website that really addresses not just the why of gold. We all understand that, or trying to understand that, but how to own gold, where to own gold, how not to own gold, what's wrong with commercial bank storage of gold, what's wrong with ETF gold, what jurisdictions to think about. These things are put forward now in a far more effective way for people to get a really solid education on the gold question.
Fantastic. Once again, Matthew Piepenburg, thank you so much for your time, and God bless.
Thank you, Elijah. It's always a pleasure.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for January 15th through January 22nd, 2024, while supplies last. This week, all our specials come from the Royal Canadian Mint, one of the most respected mints in the world. First, we feature backdated 1-ounce silver maples at $3.75 over spot with a minimum order of 50. Next, RCM new style 10-ounce silver bars at just $2.75 over spot with a minimum order of 4 bars. We also have backdated 1/4-ounce gold maples at $59 over melt when you purchase 2 or more. And finally, backdated 1/10-ounce gold maples are just $32.50 over melt with your purchase of 4 or more coins. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.